And exactly what happened in Japan. And when I'm asking the question, is the United States the next Japan? What I'm referring to specifically is the United States going to do QE infinity? Are they going to peg the yield curve? Are they going to buy everything, all the stocks and the bonds? And is the United States going to go through deflation? But to be clear, when I'm talking about deflation, and when we look at Japan, they haven't really had price deflation with consumer prices. Really just asset prices are what have gone down dramatically. So when we look at Japan and say, boy, I don't want to be them, what we should be referring to is their low real GDP growth, only about 1% if you go back to 1990. As far as their prices, we really shouldn't get fixated on that because their consumer prices have been relatively the same. It's the asset prices that have crashed, and again, their GDP has been relatively stagnant. Let's start with a chart going back to 1981. This is the consumer debt or the private sector debt to GDP. This isn't the government debt. It goes from 140% all the way to 220%. Starting in 81, it goes up to 85. And I want to point out 1985. Very important. This is a big year, and I'll explain why in just a moment. Once we get to 1985, the consumer debt, or the private sector debt, goes parabolic until we get to 1990. They're crashing. It actually goes up a couple years after that. Then we have this huge deleveraging going all the way down to 2007. It goes back up a little bit, GFC, and then comes back down to where it is 2015, around 150%. I would assume that we're right around the same today at 150% of GDP, and that's the private sector debt. If we pull up a chart of real estate prices, you'll see it followed a very similar path. Also with equity prices, their stock market, it just goes up to 1990 and then comes down, and it's never really gone back up. I want to point out the two different approaches to tackling this problem. Number one, the Keynesian approach. And for this, of course, we've got none other than our buddy Paul Krugman in his glasses up here in the right-hand corner. What Krugman would do is say, listen, we got to this point with all the private sector debt, and we don't want that to come crashing down because that's going to cause a lot of unnecessary pain. So we need the government to come in and fill the gap with deficit spending. Let's assume this blue line is the trend of GDP growth, where it was headed. So Krugman would say, listen, this blue line at some point in the future, call it 15 years, 10 years, is going to come up to a level where we can service the debt with all the income we're making from the GDP growth, and it's a win-win because we don't have to go through any of the pain. The government doesn't have to suffer. The corporate sector doesn't have to suffer. And the consumers don't have to suffer one bit. All we have to do is print up funny money, fill the gap, and we're good to go. The problem with this approach is it doesn't really work this way in practice. GDP, which is represented by the blue line, doesn't go up all the way to where Krugman is, to where it meets the level of debt or where it could service the debt. It really is more like the black line. That once the government comes in and starts spending like a drunken sailor, gets more involved in the economy, more regulations, it really starts to freeze. And we see that the GDP growth really doesn't keep going up at the same trend line. It gets stagnant and then it really kind of flatlines. The patient goes comatose. And although they're not feeling too much pain, it just gradually gets worse and worse because that level of GDP never catches up with the amount of credit that was in the system back in 1990. So what's really happening is the government is spending more and more money to fill the gap, but while they're doing that, they haven't got rid of the malinvestment, which is why the economy was sick in the first place and what took it up to those high asset bubbles. There's a lot more government control because now they're spending money. They're picking winners and losers. More regulation. M2 goes through the roof. That's the money supply in the real economy. And what that indicates is there's much higher potential for future inflation that would cause even more pain than allowing the bubble to deflate in the first place. We also have a lot of social unrest, inequality, and this takes us to this type of socialism. Not really where the government owns the means of production, but they're just so involved in the whole system, like we've seen happen since 2008. And look at what's happening now with the cerveza sickness in the United States. This is an example of government being much more involved at the corporate level and in the private sector, all the way down to the local subway on the corner or the gas station. And this happened in Japan. They get more involved, and the economy, therefore, is less dynamic. And this is why when we have the Keynesian approach, when everything crashes, the GDP or the economy doesn't really continue to go up on trend. It really kind of freezes and stays there indefinitely. Now let's look at the Austrian approach. And to walk us through this is none other than the gentleman right here holding the I love gold sign. He is Paul Krugman's nemesis. And of course, that is none other than Mr. Peter Schiff. Peter looks at Japan in the 1980s and says, look at the monetary sins. They kept interest rates artificially low, government spending, fiscal stimulus. This is why they had the bubble in the first place. So the only solution is to take the medicine. We can't try to solve the problem with what created it in the first place. And yes, there's going to be bankruptcies. Yes, people are going to lose money. It's going to be very painful, but there's no other choice. We have to let the system clear. We've got to get the excessive debt and malinvestment out of the system. If we do this, GDP is going to take a hit for a year or two, but it's going to make the economy healthy so we can get right back on the historic trend growth. And over the long run, the next 10 years, 15 years, we're going to be in a much better place as a result. We're going to have higher GDP growth, and we're going to have a much better balance sheet. Unfortunately, Japan did not take Peter Schiff's advice. They took the Keynesian approach. A lot of government spending, big deficits, quantitative easing. They took interest rates down to zero, even negative. The Bank of Japan came in, printed up all this funny money, went into the stock market, bought stocks. They went into the bond market. Now they own over 50% of government debt. Really mind-blowing stuff. But of course, the Keynesians will come in like Krugman and say, whoa, time out. The problem isn't that they took the Keynesian approach. It's that they didn't do it enough. They should have just done more government spending, more quantitative easing, and taken interest rates further negative. If they only would have done that, then they'd have a booming economy. Of course, I'll let you decide which is right and which is wrong. But how did the Japanese asset bubbles grow so large in the first place? What was the catalyst? What created this problem? Remember I said it was all about 1985, the Plaza Accord. This was the trigger. Let's go straight to a report from the IMF and you'll see why. In 1985, the United States convinced Japan and Germany to artificially devalue the dollar against the yen and the Deutschmark. As a result, the Japanese economy kind of stalled out in 1986. And to solve this problem, what did they do? They took the Keynesian approach, of course. They went in with sizable macroeconomic stimulus. Policy interest rates were reduced by 3 percentage points, a stance that was sustained until 1989. A large fiscal package was introduced in 1987, even though a vigorous recovery had already started in the second half of 1986. By 1987, Japan's output was booming, but so were credit growth and asset prices, with stock and urban land prices tripling from 1985 to 1989. Then, in January of 1990, the stock bubble burst. It sounds very consistent with what we've done in the United States over the last 10 years. We have a problem, a slow growth economy. How do we try to fix it? Through massive deficit spending, keeping interest rates artificially low, while at the same time, real estate and the stock market is booming. The exact same movie played over again. History doesn't repeat exactly, but it sure does rhyme. Step number 2. Why has the Japanese economy not collapsed, and why haven't they seen hyperinflation? From our standpoint, the whole thing should have blown up a decade ago, if not earlier. So it starts with quantitative easing. They did a different version. Instead of printing up funny money and buying assets off the balance sheets of the banks, the only thing they did is used the funny money to replenish their reserve accounts so they wouldn't go bust. The net result is the banks still had all these toxic assets on their balance sheet they couldn't really do anything with. So it didn't free up the banks to make more loans in the real economy or grow the money supply. That's first and foremost. Second is Japan is a big time export nation. So they export a lot more goods and services than they import. So why does that matter? Well, if you export more goods, then that creates more demand for your currency. It props it up. Therefore, it strengthens the local currency. So if the Bank of Japan is printing up all this funny money that would normally create inflation, there's kind of an artificial bid outside of Japan for all those yen because of the goods, the cars, the refrigerators, the electronics that they export to other countries like the United States. So just remember it this way. The more a country exports, the bigger their trade surplus, the more demand there is for the local currency. So as the Bank of Japan created more supply, the exports created more demand. That's one of the main reasons the yen hasn't gone into hyperinflation mode. Next is Japan is a nation of savers. They flat out don't like spending money. I've read a report showing that they save anywhere between 20 and 30% of their income. So the BOJ, they print up all the funny money, they inject it into the system through government spending. But the Japanese, all 5 of them here in my example, they just take the yen and deposit it right into the bank. So very little money gets outside of the banking system chasing goods and services. And we know if there's not a lot of money, if there's not more money chasing goods and services, consumer price inflation won't go up. It's one of the few things Krugman said that I actually agree with. He said that money printing in and of itself does not create inflation. Spending money is what creates inflation. And I couldn't agree more. The Japanese don't spend money. That's why you don't see a lot of local price inflation. But they're also a huge creditor nation. So what's happening is they're exporting all their stuff. They're manufacturing the widgets and sending them over to the United States. We send them dollars. They take some of those dollars and exchange them for yen. And of course, what do? They put them right into the banking system. They save it. They don't spend it. But they take some of those dollars and send it right back to the United States. They don't buy stuff. They buy assets. They buy United States real estate, stocks, and bonds. So basically what's happening is the Japanese and other countries are producing all the stuff we consume, and we as Americans are trading the consumption for our assets. And it's gotten to an extreme. Editor, go ahead and throw up the charts. We can see Japan is the largest creditor nation, and the United States is the largest debtor nation. It's measured using something called NIIP, Net International Investment Position. To understand this better, let's go to my full-length interview with financial Twitter rock star Lynn Alden. Let's move on to the core of the one report which I loved, where you're talking about creditor nations versus debtor nations.
Yes. So creditor nations, that's measured as the net international investment position, which is how much assets that people in that country or the government itself, but the total assets that that country has in other countries. So, for example, Japan owns a lot of assets in the United States and other countries. And then other countries own some pieces of Japanese assets. They could own Japanese stocks, they could own some Japanese real estate, some bonds. And the net international investment position is the difference between how much they own from other countries versus how much countries own of their assets.
Got
So
it.
a creditor nation owns more foreign assets than foreigners own of their assets, and a debtor nation is vice versa. So some of the largest creditor nations are Japan, Germany, Singapore, Switzerland, Norway, Saudi Arabia, Taiwan, and then some of the biggest debtor nations. The United States is the largest absolute debtor nation, but then there's also as a percentage of GDP, we're one of the worst, but there are some that are even worse, such as Spain, which is deeper in the, the debtor hole.
If you don't know who Lynn is, make sure you follow her right now on Twitter, and you are going to love the full length interview tomorrow. I promise you, she's going to be one of your favorites for sure. But getting back onto topic, the takeaway here is the reason Japan hasn't collapsed or seen hyperinflation. They did a different type of quantitative easing. Their exports are massive. That creates demand for yen, and they save so much money. They spend very little. And if that money stays in the banking system, and what money they do spend, they take it to buy assets outside of Japan, the local domestic economy doesn't have much more money chasing the same amount of goods and services. Therefore, consumer price inflation doesn't go up much at all. Step number 3, the main differences, and I answer the question, is the United States the next Japan? We know the quantitative easing was different. This created lower deposits in the real economy. The velocity in Japan's very low because they save so much money. They're a creditor nation. So in a time of distress, like right now, cerveza sickness, they can sell off assets for the cash flow they need to get by at a corporate level and a household level. Their exports are very high. Since they have a trade surplus, it creates more demand for their local currency. But the biggest difference is the M2 money supply. This is the money supply in the real economy. Looking at a chart going back to 1980 to 2020, it goes from $0 trillion all the way up to $18 trillion. The United States in 1990 had about $3 trillion of M2. It went up and up and up till it maxes. Well, it's not maxed out yet. It'll never max out because it's going to infinity and beyond. But right now, we're about $17 trillion. That's a 6x increase. Unbelievable. If we look at Japan, just comparing apples to apples, if they were using dollars and assuming in 1990 they also had a money supply of 3 trillion, right now it would be $6 trillion. It went up 2x. So a 6x increase compared to a 2x increase. This is huge. But before I expand on this any further, I want to point out one of the similarities between the United States and Japan. Editor, let's throw up the chart of real growth in Japan since 1990. This is GDP adjusted for inflation. We can see that it's right around a 1% average. If we look at the exact same chart for the United States, around 2.5. It's not that much different. Now I know over 20 years it's compounded, so there's a big difference at the end of the 20 years. But on an annual basis, it's very, very similar. It's not like the United States is growing at 10% and Japan is at a -5. I also want to point out that if the United States accurately measured inflation, our GDP would be very similar to Japan. So I don't think the United States is going to be the next Japan. I think they already are, from a standpoint of real GDP. We've used the exact same playbook, the quantitative easing, the zero interest rates. Now we're buying equities, or most likely buying them through ETFs. We're buying corporate bonds. It's the exact same thing all over again. We've seen this movie and how it plays out. But because of the difference in money supply, because the difference in velocity, and because we are the largest debtor nation of all times, I think we're going to have an inflationary lost decade. And what I mean by that is real GDP growth remains very, very low while we have persistently high inflation. And when I'm talking about inflation, I'm talking about consumer prices and most likely higher than average unemployment. Nothing is certain. That's just my base case. But what concerns me most about the United States and the dollar being the world reserve currency is the fact that as Americans, we don't really have control over the strength of the dollar. It's outside of the United States. It's because we don't have exports, because we don't have savings. We're not like Japan. So Japan can tweak it. They can save more. They can export more. But in the United States, we are totally reliant on the entire world wanting our dollars. And if it ever comes to a point where the world doesn't want our dollars anymore, the inflationary lost decade turns into a hyperinflationary lost decade. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.